Welcome back to Nasdaq Trade Talks. I'm your host, Jill Valentrino, Global Markets Reporter at Nasdaq. We're coming to you live from the Investment Advisors Summit in Austin, Texas. Joining me for this segment, we have Dennis Rezendes. He's the Assistant Portfolio Management at Beaumont Capital Management, and we're going to look at smart beta in a volatile market environment. Dennis, thanks so much for joining us at
Thank you, Jill.
Investment. Now let's talk about Beaumont Capital Management. How are you using smart beta?
Yeah, so just to give you a little context first, we are a ETF strategist that specializes in tactical strategies that prioritize growth, but also have the ability to take defensive posture when market conditions warrant it. So we have three rules-based quantitative systems that we use to drive our portfolio allocation decisions. First is decathlon, which is a machine learning-based model. The second, sector rotation, which is based on price momentum. Then the third is paradigm, which is based on market volatility. So Paradigm, we have a product, Paradigm US Factor Selection, which is our most pure play factor model. In that model, what we're doing is we're rotating among the 6 large, generally accepted factors: momentum, low volatility, quality, size, value, and dividend.
All right, now, what process do you use when you rotate among these factors?
Yeah, so as I mentioned, Paradigm is based on volatility. So our thesis is that volatility is a measurement of the level of disagreement that investors have on the correct price of the market. And so what we think is that when investors don't agree on what the correct price of the market should be, there's probably something wrong. And we think that when those conditions are occurring, tail events like large drawdowns are more likely to happen, and just generally you're not as well compensated as you should be for taking market risk. So we have an ensemble of models looking at short-term and long-term realized volatility for each factor. Based on those parameters, we determine whether the factor is in a volatile paradigm or a non-volatile paradigm, which is where the name comes from. If the factor is in a volatile paradigm, we put cash in the portfolio instead. If it's in a normal paradigm, then we risk weight all of the factors to get to the model's target risk allocation.
All right, so now during this recent volatility that we saw in December and the beginning of the year, how did Paradigm react during that period?
Yeah, so Paradigm's reactions to the market are generally pretty intuitive, which for a simple model like Paradigm, we have a pretty simple thesis, and so we'd expect what it does as we go through market volatility to kind of make sense to investors. When volatility is low, we tend to have pretty high weightings to momentum, and that was the case going into the fourth quarter. As volatility spiked, we rotated away from momentum and towards low volatility and quality, also added some cash. When volatility spiked for the second time in December, we started to really reduce our market exposure. We got to about 70% cash, and at one point, low volatility was the only factor that was still in the portfolio.
Right.
Then, as volatility started to subside coming into the new year, we reallocated into the factors and slowly got back to a fully invested status as the market started to calm down.
All right, Dennis, thank you so much for joining us at InvestNet. And thanks for joining me throughout the day on Trade Talks. I'm Jill Valentrino, Global Markets Reporter at Nasdaq.